He's sharing part of his Friday morning with us. Larry, we appreciate that. I wanted to get into some of the numbers that are coming across the wire here. I guess first and foremost, inflation, a major focal point for the Fed, obviously this week. I do want to point out personal income coming in a little bit higher than expected at, well, 0.6%. The personal spending came in down 0.2%. Here we're looking at the employment cost index, also topping expectations quarter over quarter at 0.7%, and I'm looking here at, well, year over year at 2.5%. But this was a pretty strong number across the board as well, Larry. Core PCE price index coming in higher than expected, 0.3. They were looking for 0.1. Is it something that's going to raise inflation concerns, or just a blip on the radar at this point?
Yeah, I think it might be a small blip on the radar, and I think the markets were cast back like Wednesday night with the FOMC. Thursday's GDP came in underwhelming expectations. These numbers today are a little bit more second tier, perhaps subject to revision, et cetera. All that to say, it'll make the last day of the month fairly interesting because inflation has been the talk of the town. It's what's been driving sentiment in FX and rates markets. So it'll be interesting to see what happens.
Yeah, I'm looking here right now at this personal income and spending, and it actually may not be, I'm noticing personal income last got revised down 1.3 from down 1.1. Personal spending, it looks like, also got revised lower prior, that is, to down 0.7 from down 0.4. But this personal spending number down 0.2, that's got to be a little bit concerning, maybe not alarming, but concerning considering some of the uncertainties, some of the unknowns related to consumer trends that have been playing out as the pandemic, just, these variants, the unknowns related to vaccines. We just talked a little bit a minute ago about the Johnson & Johnson breaking news here, Larry, but we want to really see these, consumers. We want to see the spending start to pick up, correct?
Oh, yeah, absolutely. I think that's what drove the market last year.
Big time.
It kind of saved the day for the entire market. And so for that to carry over is crucial for any kind of recovery that we have. And I think that's the big misnomer or the big question mark. Will the consumer come back? Will the consumer come back the way they were in 2020? And will it drive markets the way they have last year?
Larry, I guess that one could argue that we're starting to see this a little bit in terms of reflection of crude prices. I've been saying that, well, the market, the indices at least, with low rates has been a little bit maybe exuberant, one could argue, but crude seems to have a little bit more of a level-headed approach towards some of this optimism associated with vaccine news and this sort of, light at the end of the tunnel sort of narrative. I mean, crude running up recently up through the $50 level, but it's really stalled out for the most part. Some could argue the dollar to the downside, momentum, losing some of that momentum has taken out the wind in the sails in terms of crude. You can see here, though, how it's kind of plateaued 50 to 55. What are you watching as far as the WTI?
Yeah, well, right now, as you mentioned, the crude is basically finishing the week or opening the end of the week where it was on Monday. And it seems like the move was much more dramatic than that. But we were like 52, 53 on Monday. That's where we are right now. And so I think a lot of it is just more on the demand side, because we don't know, but like the supply side of the story seems to be a little bit more stable than the demand side, which is like almost opposite of what we've been watching and looking at the past few years. It's really always been the supply side. So all that to say, really it's just more vaccine, economic data, especially coming from Asia, what that's going to do to drive demand and will continue to carry over because right now, like demand has been strong, all things considered. So that's really what I'm looking at right now with regards to WTI and also natural gas.
Yeah, we saw that with the inventories this week, a large draw down 9.9, I think it was, and certainly something to keep an eye on here. Larry, how closely is this tied to the jobs? We're actually looking at silver here. I'm going to get into the metals with you in just a minute, but how closely is this discussion in terms of crude, the range that we've been stuck in, closely tied to the labor markets? We'll get some more insight as far as employment data here in the U.S. next week, but I mean, again, I've been arguing for a while now. If we're not seeing those jobs return, one could argue if you're not seeing people return back to the office, but ultimately if the jobs aren't coming back at the rate that we wanted to see them, then that's going to kind of keep a lid on crude prices as well.
Yeah, no, I think you brought up a really crucial point. I mean, one that a lot of people overlook, and that is the fact that will we be driving more? Will jobs come back? Will they come back the way we think they will or hope they will? And is it going to be a K-shaped recovery or what? And so all that in mind, you see that oil has been trading in a pretty violent range, although it's a narrow range. But the intraday moves have been just violent. And I think there's just so many unknowns. And traders just looking at things like jobs numbers and the trek for the recovery and what that means. And so for now, I just think oil is going to remain in a very, very violent but narrow trading range until further notice.
Let's talk metals, Larry, and what's been playing out there. We're looking right now at the energy markets across the board of green, even with the indices struggling a little bit this morning. But, interestingly enough, gold, for the most part, kind of muted reaction this week to the Fed, sort of limited, for the most part. Recently, one could argue, after coming off that 2100 level, we've seen a bit of a channel to the downside, a series of lower highs, but we've held above key support around 1750, 1800 in that area. Here you can see the chart, the daily time frame, basically since this summer of last year, how we've been sideways. Now, silver, a little bit of a different story here. If we could pull this chart up, because you can see how now silver's actually starting to get a bit of a bid. Silver's in the purple line here, gold's in the candles in this case. But Larry, what are you watching here in terms of metals right now as far as gold, the dollar, gold inflation? I mean, it just really hasn't been moving.
No, you're right. And I think for me, I'm looking at any indicators on inflation because, as you know, and as most people know, gold sometimes acts as a commodity, a safe haven, a currency, a inflation hedge. It can be something different depending on the environment we're in. And I think right now it's really more about inflation or the lack thereof, or dovish central banks, around the world. One of the issues is that the central banks continue to act dovish. But when you come to some or a lot of central banks, they're limited in their scope and what they can do from here on out. And so gold is like pent up, waiting to make that next move. But I think a lot of it has to do with inflation. And you see that carryover also in the FX markets.
Do you think we need to wait, Larry, to see some more inflation or maybe some more stimulus to come, something a little bit more concrete than just kind of this talk of this $1.9 trillion package to see gold start to move back higher again? I mean, obviously, if the dollar were to take out the 89 even low, one would argue that we should see some movement to the upside. But talk to me. I mean, there's a lot of focus on yields, the inflation, as you mentioned, but is that what we need here as far as the next catalyst to get us back up above that key level?
I think so. I can't see what else it would be at this point. And I think that's what's underpinning the whole market. And we saw that happen post FOMC on Wednesday, and then with the GDP report on Thursday that missed expectations ever so slightly. All that to say, I think the inflation narrative definitely second to vaccine and trajectory of immunizations, all that. But
without it.
Inflation, the inflation story is so important. And what's fascinating is that it really hasn't affected the FX markets this month. It's a little worrisome, actually, when you see the Euro FX, the move was sub three-figure this month, which is the lowest two-thirds range in the last 25 years. Japanese yen was a two-figure move. And so I think there's a lot of pent-up dollar shorts out there and keeping these markets in range. I know I'm going off chart, but it does have to, some type of correlation between that and the other markets, especially metals.
No, I'm glad you brought that up. I was actually just looking back because overnight we saw Tokyo core CPI coming down 0.4%, a little bit better than they were expecting in terms of they were looking for worse than that, negative down 0.6, but it improved from last month's down 0.9. Year over year, though, down 0.5, improving as well slightly, but nothing to be too concerned about there, in line with the trends we've been seeing in terms of inflation. Larry, what are we watching for next week in terms of potential market movers for the commodities? I'd imagine a major focal point being jobs. What else do you have your eye on?
Yeah, definitely looking at 10-year Treasury yield and how that reacts to information that we receive next week. Recall this time last week, 10-year Treasuries were like 112. I think they closed at 109, and now we're down to 106. Will that continue? Will we see that break below 1% in the next support level, they say, is like 94.4, or will we ratchet back up with the inflationary ambitions? And I think that has a lot of weight next week, and that's what I'm watching to see if we're going to break out of that range or if we'll just stay comfortable where we are right now until further notice.